Hello, this is going to be a walkthrough video of the first AAT sample assessment for the Q2022 Financial Accounting Preparing Financial Statements Unit, otherwise known as FAPS. So let me share the screen with you. Okay. So this is the screen for the new software. So it's a 2.5-hour exam with 6 tasks to complete. Total marks available 120. Right, task 1, about using day books and accounting for and monitoring non-current assets. So, complete each of the following statements. Details from credit notes sent out regarding a prompt payment discount will initially be entered into the, well, it's a prompt payment discount. They're being sent out, so they must be being sent to our customers. So it must be the discounts allowed daybook. Details of cash sales. So cash sales, the cash book, remember the sales day book is only for sales on credit. If an item of revenue expenditure is mistakenly classified as capital expenditure, what is the effect on the following items in the final accounts? So revenue expenditure has gone in as an asset. So that means that I wouldn't have subtracted that expense, and therefore my profit would be too high. My non-current assets would also be higher than they should be because I've put an expense in as an asset, so the asset figure is going to be bigger. My current asset, no effect. And neither are my current liabilities. If you think about the double entry, so debit, we've gone debit the asset, the non-current asset, so that's too big, and we haven't gone debit the expense, so therefore my profit's too big. Nothing else would be affected. Complete the following statement about depreciation. Depreciation is an example of the, okay, so my choice is materiality. Well, that's when something is significant enough to influence decisions of people using the account. So it's not that. The accruals principle, I think it is going to be that, because the accruals principle is matching expense and income into the correct period. And what depreciation does is it matches the expense of using the asset over the time that you have it. So that looks like a good answer. The business entity principle, that's where the owner and the business are separate from one another, so nothing to do with depreciation. You're working for Dev Johnson, a sole trader with a financial year end date of the 30th of June. Dev is registered for VAT. So that means he's going to be able to reclaim the VAT on anything that he buys. Hence, we can ignore it when we are thinking about the value of the asset. So Dev purchased a van for use in his business on the 31st of March X3 for $27,500 plus VAT. As we've said, we don't need to worry about the VAT because that will be reclaimed. He has a policy of depreciating vans using the straight line method at 20% per annum, assuming a residual value of 10% of the purchase price. Depreciation is prorated for every full month that the van is owned. So that just means we've got to do it on a month-by-month basis. And then he disposes of the van on the 1st of February X5. Right, so let me get my calculator. So to calculate the depreciation on the van, it's straight line. So we know that the original cost is 27,500. and we have to subtract the residual value because that's what we expect to sell it for at the end, which is going to be 2,750. So I'll just do that now. So that gives me a depreciable amount of 24,750. And I've got to apply a 20% rate of depreciation. So the annual depreciation charge will be 4,950. Calculate the accumulated depreciation on this vehicle immediately before its disposal. Right, so I know I'm interested in the number of months that I've held the asset because I'm depreciating each month. So I need to figure out how long I've actually had the asset altogether. So I got it right at the end of March, so we can ignore March and just count from April X3 onwards. So we've had it from April X3, so right through to the following April X4 would be 12 months. And then we're going through to the 1st of February. So April, May, June, July, August, September, October, November, December, January. Don't count February because it's the 1st of February. So I make that 1 year and 10 months that we had the van. So I want 1 full year's worth of depreciation, so 1 lot of 4,950, and then I want 10 months worth. So if I divide the 4,950 by 12, I get 1 month's worth, and then times it by 10, that gives me 4,125 for 10 months. And then I want the full year as well, so add on the 4,950, and that gives me an answer of 9075 for part B2. Right, Dev purchases a new van from Pete Smith on the 1st of February X5, trading in the old van as part exchange. The list price of the new van is 36,000 plus VAT. He receives a part exchange allowance of 9,500. And he pays the balance by bank transfer, right? So Dev is handing in his old van, getting 9,500 for that, but the list price of the new van is 36,000 plus VAT. Right, complete the disposals account for the disposal of the van, showing clearly any amount to be transferred to the SPL. Right, so whenever I do a disposal, go through it methodically, step by step. So step 1 is to get rid of the original cost. Right, so we know that his original van cost 27,500. That's what would have been sitting in the cost account. It's an asset, so it would be sitting as a debit in the cost account. So to get rid of it, we're going to credit the cost account and debit the disposals. And the narrative for that first box will be vehicles at cost, because that's the other side of the double entry. The second step in a disposal is to get rid of the accumulated depreciation. So we've just calculated the accumulated depreciation was 9,075. So that would be sitting as a credit in my accumulated depreciation account. It now needs to be got rid of. So I'm going to go debit accumulated depreciation and credit the disposal. The narrative is the other side of the double entry, the account it comes from. Then we know that we got 9,500 for this item. So we didn't get money in the bank, we got a contribution towards our new van. So what's effectively happening is we're going debit the new van, the asset, with 9,500, and credit the disposal with 9,500. So that's the proceeds, but we've got to be careful here because this time it's a part exchange, so the other side will be that it's going towards the cost of the new van. All right, so always remember a disposals account will always have these three entries: the cost on the debit side, the accumulated depreciation, and the proceeds on the credit side. So C for cost, A for accumulated depreciation, P for proceeds, because it might be going towards a new vehicle, it might be money, depending on how they've disposed of it. Spells the word cap. You can imagine the cap sort of coming down there to help you remember what the disposals account looks like. Right, so then we need to balance it off. So it's conveniently put the totals in for us. So we can work out the difference here, which is 8925. And that will be my transfer to the statement of profit or loss. Don't be tempted to put balance carried down. This is an account which belongs in the profit and loss account, and it tells us it's a transfer to the statement of profit or loss. So incidentally, that 8925, just thinking about whether that is a gain or a loss on disposal. Well, I know that when it arrives in the statement of profit or loss, it will be a debit, which tells me that it must be a loss. Another way to think about that is if we look at the value of our asset, it started off as 27,500. If I subtract the accumulated depreciation, the carrying amount of my van was 18,425. I only got 9,500 for it, so clearly I have made a loss. Dev will be paying the full VAT amount which is due on the new van. Right, so he's got to pay the whole amount. They've helped us out there. I mean, we should have known that really. So the list price of the new van is 36,000 plus VAT. So I've just calculated that as being £43,200. He may well be able to reclaim that VAT, but he has to pay it to the person he's buying the van from. So he's going to have to fork out 43,200. He's got a trade-in with, 9,500 for his old van. So if I just subtract that 9,500, that gives me an amount to be paid of £33,700. Part 5, Dev is recording we've already talked about that. I didn't know that was coming. A loss for the reason I explained previously on the van. Prior to adjusting for depreciation, an extract of Dev's trial balance is as follows. His policy is to use the reducing balance method at 20% on the value of the asset, assuming no residual value. There has been no adjustment for depreciation. Right, so we've got office equipment at cost and we've got the accumulated depreciation figure, but this is prior to adjusting for depreciation. So this depreciation figure must be from previous years. Complete the journal to account for the depreciation of office equipment for the year to 30th of June and do it to 2 decimal places. Right, okay, so I know that when it's the reducing balance method, we have to calculate that based on the carrying amount of the asset. The carrying amount of the asset is the cost. Bear with me a second, the washing machine's just finished. Right, so we take the cost 47857, subtract the accumulated depreciation to date. That gives me a carrying amount of 29,577. It's 20%. So I'm going to find 20% of that figure, which comes to £5,915.40. Now it says here, complete the journal to account for the depreciation. I don't really like the use of the word balances here because it kind of makes me think, well, do you want it after you've done the journal? But no, it doesn't. It just means which accounts are in play. So whenever we're putting through a journal for depreciation, we know that we have to debit the depreciation expense. and the amount was £5,915.40. And we know that we have to credit the particular category's accumulated depreciation with the same amount. Any journal must have equal and opposite debit and credit figures. Now, just a word about why we do it like this. So when you're depreciating an asset, the expense part is recognising that you are using the asset. So your business must incur an expense for the use of that asset. So that's why you have an expense. The reason we credit the accumulated depreciation is because if we just sort of think about this again, cost minus the accumulated depreciation gives us the value of our asset. So obviously by making this accumulated depreciation figure bigger, we are reducing the value of our asset, which is what we want to achieve over time, so that we're showing it at a fair amount in our accounts. Dev is trying to reconcile his general ledger to the non-current asset register. Right, so his general ledger is where the double entry happens. So similar to what we've just been looking at up there, we'll have a cost account, an accumulated depreciation account for your non-current assets. The non-current asset register is simply a list that gives you information. If you're running your business, you know, what assets have you actually got? Where are they? How much were they? What are they worth now? You're basically all the information about your non-current assets. So two quite separate things: general ledger part of the double entry system, non-current asset register, extra info. He's looking at fixtures and fittings. The balance in the general ledger after depreciation is 72382. Right, so that's what his accounts are saying he's got in terms of his assets. On the non-current asset register, the carrying amount is much less. Right, so there's a problem. Why do the accounts not have the same figure as the non-current asset register? Identify whether each of the following statements could have caused the discrepancy. Right, so if depreciation for the year was omitted, that means that I haven't reduced the value of my assets in my accounts yet. So that could explain why my books, my accounts, are showing a higher figure than the reality. So I'm saying that that one could have caused the discrepancy. Let's look at the next one. An acquisition was included with VAT in the non-current asset register. Right, well, if something had been included with VAT, it would have been at a higher amount. So if that had been the case, we'd expect this number in the register to be higher than what's in the ledger, and it isn't, it's the other way around. So this could not have caused the discrepancy.